Rob's Child, no investment advice. Welcome back to the series where we review every chapter of Benjamin Graham's The Intelligent Investor, second edition from 1972. Again, this series is intended not to replace any content of the book, but rather to supplement it, to bring it up to date, to see how relevant it is or isn't in 2024. And also, I give my own commentary relating this book's content to what I've learned from studying Security Analysis second edition from 1940, the real big book. Again, to read the book yourself, there is a link in the description of this video, a PDF of the entire book. Today's chapter is Chapter 16, Convertible Issues and Warrants. So first, let's just do a quick review of what is a convertible and what's a warrant. A convertible is really nothing more than a bond or a preferred share, which are both fixed income instruments that have the right attached to them to be turned in for a certain number of shares. So let's say you have one bond, and then with that bond you can turn it in for 3 shares, for example, and that's just part of the corporate structure. It can make bonds more attractive for being a convertible versus not being a convertible, because you get the potential upside along with assumed security of the issue. Although Ben Graham doesn't typically love the issuance of convertibles. Like if a company has to offer the convertible feature on a bond, it kind of is like, well, why don't you just offer the bond? Why does it have to be convertible? It actually correctly will give smart, intelligent investors a little hesitance when they see convertibility. Because at the end of the day, a convertible is, what is it? Is it a bond or is it a stock? And why are you buying it? Are you buying it because you're hoping that the stock price will go up? Well, then why not buy the stock? There's that whole big, long argument going through that in detail in security analysis. And then the other thing is the warrants. So a warrant is really nothing more. It's the same as an options contract, really. It's the right to purchase shares from the company at a set price, and it has an expiration date. So if it expires and the price doesn't get up to the warrant strike price, then the warrant becomes worthless. It becomes worth nothing. A key difference between warrants and options contracts is warrants are usually longer dated, so they might not expire for 3 or 4 years. And then also, in the past, the original idea with warrants was to attach them to bonds. So if you bought a bond, you also got a warrant, which is, to sweeten the deal a little bit on your bond purchase. Again, bells and whistles added to the bond to try to make them a little more attractive. And then later on, companies had begun to sell warrants alongside the stocks, and Graham pretty much blows a fit over this and how awful it is, and how companies doing that are really not being very good or nice. They're basically just tricking people, because at the end of the day, all you're doing is diluting the stocks. If you need to raise more money from the stock, then just sell more stock. Don't try to do this trickery with warrants. And that really sums up the chapter, but let's get through it. So first point on convertibles, he says there's 2 issues. First, how do they rank as investment opportunities and risks? Second, how does their existence affect the value of the related common stock issues? So those are the questions we set out to try to answer. And then we say that convertibles are great. Common stockholders become temporarily limited. Like I said in the beginning of the show, I think I said it, unless that was the first time I tried to record this. Anyway, point is, he generally likes convertibles. And once all the convertibles are converted to stock, then the common stockholders no longer are sitting on the problem, and which is the problem is, it being temporarily limited to the upside, because once the stock price gets past the the value of the equivalent of the bond value, then it makes sense to turn it in for the shares and sell them on the secondary market. One very important note he says is that convertibles are issued most in bull markets, and bear markets make them look a lot worse. And there he has a chart showing how the average decline of a convertible issue is 30% versus straight issues being only 9%. So that convertibility premium that the convertibles are holding, while people are still holding them apparently, obviously lose quite a lot more value in a bear market. And this key point here, convertibles are issued most in bull markets, is sort of a testament to the idea that this really is like, bells and whistles to try to make it seem a little more attractive. So, in bull markets, people are buying everything that comes out. When companies issue, when new companies come out with IPOs, for example, and they're selling all this stock, and everybody's buying stocks, it's like, yeah, everybody feels like they're getting richer every day. That's what happens in bull markets, which don't last forever, by the way. Depending on how long you've been in the markets, there are bear markets, but I digress. He mentions notably that convertibles even performed worse than the common stock within a certain time range. Convertibles having that fixed income aspect to them, you would think that, they'd be able to withhold their value better than the common stock because of the guaranteed payments, but being a convertible, actually showing that they can perform worse within certain time ranges. And then, in a nutshell, a convertible betrays an absence of genuine investment quality for the issue. Now, as I said before, he does like convertibles, but again, same with junk bonds. He never likes to get them at par. He never likes to pay full value for them. There are circumstances where they can become very obviously very undervalued, and that's when they can become interesting, fun, and profitable. But when when you're buying it straight from the issuer on when they issue it, it is betraying an absence of genuine investment quality, like I have been saying. A good, dependable bond will pay its payments and function the way that it's supposed to function without bells and whistles on it. And if you want to participate in ownership of the company and, the leftover assumed profits, then that's when you should become a stockholder. Bonds and stocks. Keep it simple. He doesn't again, with preferred shares, he generally hates preferred shares, again, unless there's certain circumstances when they become obviously very undervalued. And then we have a note that convertible preferred are safer than the common shares of the same company, sort of. Again, being a senior issue, it's still a bond. It still has to pay you out. And if the company goes bankrupt, they have to sell everything they own, and they have to give it to you, the bondholder, before the stockholders can get anything, obviously. So moving on, many times convertibles work out well, but more likely to prove a pitfall. So in general, stay away from them, I guess. It kind of goes counter to what I said at the beginning, that he likes convertibles. I meant he likes convertibles in certain circumstances when they are massively undervalued, and that's only in those circumstances. So then we're faced with a dilemma. Should the holder sell on a small rise, or should he hold for a much bigger advance? And he basically walks through he doesn't call it FOMO, but this is what he's describing. He walks through someone holding a convertible bond, seeing the price of it going way up and getting, a fear of missing out of, further advancement in the price of the convertible. So then, his typical gain, by the way, through security analysis, everywhere you look, his thing is 30%. Try to aim for that 30% return. Buy stuff that's a 30% discount. Sell stuff at a 30% premium. 30% is like the magic Graham advanced number. So he asks here, sell it at 25 to 30% gain as a policy. Should you do that? And he says no, because convertibles are usually most issued in the later stages of bull markets. And so to assume that you're going to get that 25 to 30% gain when you're already deep into a bull market, and assuming that, and the further you get into a bull market, the more likelihood there's a bear market coming, by the way. And so hoping to get a 30% increase there, no, bad idea. And again, most of these things, you find them coming out all at the wrong time, when you really should be staying away from them anyway. And then he goes through a story how he got burned hodling. I did not spell that wrong. Hodl means hold on for dear life in modern linguistics. But he got burned for basically holding on way too much, hodling. In one of these instances, it went up 100%, and then later he ended up going down 75% from its issued price. So he bought these things, they doubled in price, and then lost that doubling price. In other words, went down by 50%, and then a further 75%. So he ended up with sitting on 25% of his original investment. What a roller coaster that must have been. But he hodled through it, and he got burned, and he learned his lesson. And we have a quote, old maxim of Wall Street, which runs, never convert a convertible bond. He cites the loss of the protection the buyer wanted in the first place. And yeah, so if you're holding a convertible, and he goes at this at length in security analysis, the same exact argument. If you're holding on to a convertible and it's doubled in price and you're sitting on it, well, why did you buy that convertible in the first place? You bought it because it's a bond, and you were hoping to, maybe get gains if the stock price went up. But now what are you? Do you consider yourself to be a stockholder and it doubled and you're still going to hold on to it? Or are you a bondholder and you're perfectly fine with it, dropping by 50% and then another 75% because, you believe the company's going to keep paying those coupons, and, you're okay with the roller coaster. So it can complicate the psychology of the investor greatly. I have another quote from the book. Wall Street has a few prudent principles. The trouble is that they are always forgotten when they are most needed. Hence, that other famous dictum of the old timers, do as I say, not as I do. This statement right here is so important. And the phrase that I get from this and reading this, you can zoom out and use this on a more general idea for investing in general, which is that how many times throughout history do we have to say it's different this time? Yeah, last time it turned out to be terrible, but this time it's different. Don't worry, everybody. Stonks to the moon. Who cares about, intrinsic value or valuations or anything like that? They just keep going up in price. So, forget about it. No, don't forget about it. So much so that people have to say, do as I say, not as I do. Because even the old timers, even people that have gone through making the same errors over and over again, make the same errors again. That's sort of how I read that. So yeah, going totally against what I said in introducing the chapter. Sorry about that. He simply mistrusts convertibles. So again, I swear he's talked very positively about convertibles, but only when they're like crazily cheap in certain circumstances. There's arbitrage circumstances and stuff like that. But in general, he mistrusts convertibles, from my notes on the chapter. And there's a quote here: the investor should look more than twice before he buys them. Look more than twice. So not just twice, at least thrice. We move on. He mentions that it is hard to find good new issues of convertibles that are secure and with a low stock price. So in other words, you're not paying much premium for the convertibility yet. But he says it's possible to find these things. But it's actually easier to find an old one at a discount. And he has I don't even know how many chapters in security analysis. By the way, I do plan on going over the entire book again, security analysis. So if you've seen that series or seen my videos on that series, I'm sort of planning to redo the entire book again to go deeper. But anyway, I digress. We're going to move on. There's an example of American Telephone and Telegraph Company, great convertibles, but you'd have been better off owning the stock, had a solid dividend. To prove convertibles are good, you need to see a lot of examples of convertibles faring better than the common shares. Such instances are not easy to find. Again, in a nutshell, if you want a bond, just buy a bond. And if it's a convertible bond, be a little suspicious. And if you want to participate on the stock price going up, then buy the stock. And that's it. All right. So then we move on. Subtitle: Effective convertible issues on the status of the common stock. How convertibles can be added through mergers, add earnings but dilute the stock, mixed effect. Today, when it comes to dilution through convertibles, I don't believe it's typically an issue anymore. I believe most of the numbers that you get, correct me in the comments if I'm wrong, but most of the numbers that you get out there are fully diluted. So they're already accounting for any kind of dilution that might happen in the future. But it can also get more complicated through mergers. Then we have a subtitle: Indicated switches from common into preferred stocks. I put a note here. It took me a long time to understand this section. I even used ChatGPT, and I argued with it for a while, and I figured out at the end of the argument, ChatGPT I don't think understands this part of the chapter at all, but I finally do. This part literally took me, I'm not going to lie, like 45 minutes or longer. To get through this. But the point of this little section is that some periods have higher common stock yields than the preferred shared yields, but when the common has a lower dividend and selling close to parity of the convertible preferred, that's when it's a great idea to sell the common and buy the convertible preferred. Even if it's off by a little bit, it's okay. In an example he shows, because the payment, the one payment would cover the difference. So this sentence basically sums up that entire section very well. Remember, and this is talking about basically at parity, but when the stock has a smaller yield, then yeah, that's when you should switch over to convertible preferred. I don't know how often those kinds of situations come up, especially anymore in today's age with, AI traders now getting involved. Maybe they still exist. I'm not sure about that. And then main point here, the convertibility feature, practically, the way this works is that practically, for practical purposes anyway, limits the downside to the share parity of the stock value, and also has the advantage of growing with the stock price, and it has a higher dividend yield, and it's a senior debt. So if the company liquidates or goes bankrupt, you have a senior position. You'll get paid before the stockholders see a dime. And stockholders, and then usually in a liquidation or a bankruptcy, will get wiped out. but the preferred shares might get something. So anyways, this whole thing it ends up being more of an arbitrage more than anything else. Seeing sort of a discrepancy there between the value of the convertibles and the common. All right, finally we move on to the part of the chapter where we talk about warrants. This is like part 2. So stock option warrants is the next subtitle, and not a fan to say the least. If you're just watching the video, please read through what he says here. I only quote a little bit of what he said, quoting him: recent development of stock option warrants are near fraud and no excuse for existence, and misled speculators and investors, and should be prohibited by law. Now, again, they used to be more of additives to bonds, and it was less of an issue for him at that point. But apparently, before he wrote this book, there was a period where issuing of warrants sort of got out of hand, and he cites an example where there was a company issuing warrants attached to every share of common sold at the IPO. And this is just like, okay, it's funny. Like, to me, that sounds attractive, right? I'm getting these like long dated options. So if the stock price goes way up, then like I make so much more money because now I have a warrant. Not just did I, get the common stock, but now I have a warrant too. Yeah, go me. Hold on. There's just free money that just exists now. Yeah, so he basically goes through how, and I've gotten caught in this too. I've gotten caught in this thinking that warrants were a better deal than they are. All they really end up doing, by the way, if depending on the size, if there's too many of them, all it ends up doing is limiting the advance of the price of the stock itself. And he says that. So dumb people don't realize that common stock is worth less with warrants outstanding than otherwise. So they'll pay more than what's really deserved. And I bring up Core Scientific. I don't remember the full details of that situation. I was invested in Core Scientific when it went bankrupt, and I think I ended up with some warrants, and now they have you can buy the ticker CORZW, which is multiplied in 7, by the way, since it's initiation of selling those. So, but anyway, I'm not sure how relevant that is to the situation. But the bigger point that I get out of this is that, yeah, warrants, they seem really attractive, but the fact is that they really do, they limit the potential value of the stock going up, especially if there's like tons of them. And I don't think that is counted in part of the dilution. Again, I have to dig deeper to understand that aspect of it a little bit better. Until then, we're just going to get through the rest of the chapter. If you know anything better, by the way, if I'm saying anything wrong, please correct me in the comments. I'd love to be able to better understand any of this material if I'm making any kinds of errors for myself. But anyway, moving on, they don't help the company raise money when they're exercised. They serve no purpose other than to fabricate imaginary market values. Moving on, subtitle, the last part of this chapter, a practical postscript, he calls it. And he discusses about the birth of warrants. He has some old quotes about it and about the whole issue, the way he sees it. And then last point is that some warrants attached to bonds is okay, but too many warrants is not right. They should just really sell more shares. If the purpose is for the company to raise money through the sale of, ownership of the company, just sell more shares. Why be skeezy about it? Why try to trick people into thinking that they're purchasing leverage when all they're really doing is weighing down the potential gain in the price of the shares to begin with? And that's all for this chapter. Chapter 16, Convertible Issues and Warrants, the Intelligent Investor. Revised edition 1972 by Benjamin Graham. Hope you enjoyed. Thank you for watching and see you next time. Rob's Child.